Hi, this is Brandon Jackson, Director of Finance and Analytics here at Stonegate. Today's topic is leverage. Leverage is the effect that's created when you borrow money to purchase an asset. When a business wants to purchase an asset, let's say an asset costing $100,000, they have two options. They can spend their own money or they can borrow money and spend part of their own money to purchase it. Assuming that they spent their own money, they own 100%. So if down the road the asset goes up in value 25% and you're able to sell it for 125, they make the difference between the purchase price and the sales price, which represents an increase in what they put in of 25% or $25,000. Now it goes the other way too. If their asset went down in price after they purchase it and they sell it for 75, they experience a loss of 25% and end up with a loss of $25,000 on the original $100,000 that they put in to purchase the asset. Leverage creates a multiplier effect of gains or losses. Take, for instance, the situation where you're buying the same $100,000 asset, but you're able to borrow half the money to do it. So the firm puts in 50 and the bank puts in 50 for the total purchase price. And on down the road, let's say the asset appreciates the same 25%. In this case, you sell here for 125, but you still have to pay back this 50 grand loan, which leaves you $75,000. So the difference of 75 to the 50 that you put in represents a profit of $25,000 or 50% on the original capital you put in. That sword cuts the other way too. If the asset goes down in price or value and you're only able to sell it for $75,000, you still owe the bank $50,000, which leaves you with 25. Clearly, when you pay 50 to get in and you come out with half the amount of money, 25, you have a return on your equity of a loss of 50%. This is a critically important concept to remember when margin trading. Although you can boost your returns and enjoy a return of 50% versus 25%, you also open the door for losses that cut the other way, and you can lose half or more of your own money due to a depreciation in the value of the underlying asset. Thanks for tuning in.